Welcome to the Capital News. I am your host, Alex Koritis. Today is April 10th, 2019. Thank you so much for joining me. I hope everyone is doing well out there. Let's get straight into the market news. On the U.S. side, the S&P was up 10 points. The Dow closed up 6.5. NASDAQ closed up 55 points. And the Russell 2000, the small cap index, gained 22 points for the day, which translated into a 1.4 percentage point gain for the day. So they were down over a percentage point yesterday. They're up 1.4 percentage points today. What is going on in the Russell 2000? These are the small caps. Typically, if you have the small caps catching a bid, it typically means that there is more people. It's a risk on, is what they say in the financial media. It's a risk on environment. People are willing to bet on the underdogs of the market, if you will. Not that all of these companies are underdogs by any stretch of the imagination, but their market caps compared to that of ExxonMobil and Apple and Amazon and Royal Dutch Shell and all that stuff, I mean, they're the underdogs, relatively speaking. So if they're catching a bid like this, it typically means that the risk is on. That's the trade of the day. But yesterday it was risk off, right? If that's how you're going to look at it. So this is whipsawing. This is the volatility I've been telling you guys. Look for these 1 percentage point moves up or down on a daily basis. And that's exactly what we're seeing right now with the Russell 2000. And typically from my research, when I look at my volatility model, increased volatility brings with it downward markets. That will ultimately be the trend. That's what will end up breaking. Is it 100%? No, nothing's 100%. But that's my model. That's what I've looked at historically speaking, and that's typically what you see. It's not imminent. It doesn't mean it's going to happen tomorrow. But when you see an uptick in volatility, it usually means there's more movements to the downside than to the upside. Same thing like when you see very low volatility. That's typically indicative of there going to be a stronger move to the upside. Is that 100%? No. But that's what it's indicative of. And that's what we saw really in 2017. Very, very low levels of volatility. And you saw the market go up, up, and up. Made new highs. You saw that through 2018. Volatility picked up in the latter half, specifically the last quarter of 2018. And what came with it? Downward movements. Big downward movements. Correction territory of 10%, bear market territory of 20%. These are more or less arbitrary numbers, but that's what we're working with. That's the language, that's the lingo. When somebody says you're down 10%, oh, it's in correction, or it's down 20%, oh, we're in a bear market. Those are anecdotal. It's one piece of the puzzle, if you will. It's a much broader array of items, of pieces of the puzzle that you have to look at to make the determination as to whether or not you're in a bear market or not. Whether we are or not is up for debate. There are smart people who say we are in a bear market, and simply what this is this has been a bear market rally for the past couple months. And typically speaking, historically speaking, some of the largest rallies in the stock markets have occurred during bear markets. So they have, some evidence in their corner. And then, of course, you still have the people who are saying, nope, it's party on. This is still the same bull market we've been in for the past 10 years. Party on, keep it going. We got a new keg of beer here. The beer guy's going out. He's going to get more. We're not done. I mean, everybody's having a good time. Some people passed out, but they're waking back up. The party's going to go. Believe me, it's going to keep going. That's the side. So you got both of those arguments. We're in a bull market or we're in a bear market. I really don't want to get back and forth as to what market we're in. I want a truthful market. I want a market that understands the fundamentals of the economy of which it is operating in. That's what I want. And whether it's a bull or a bear, I couldn't care less, because you can make money on both sides of the trade. But you have to understand what's going on. And when you have a stock market that's so disjointed from the underlying economy, not even the underlying U.S. economy, but the global economy now, because so much of the S&P 500 gets so much of their revenues from overseas, that's still disconnected. That's still disjointed. So even if you were to say, well, look, here are the fundamentals of the economy, globally, domestically, whatever you want to say. And then here's the stock market, which is just behaving erratically. It's disjointed. So even if you were to say it's a bull market or a bear market, how do you respond when you have these types of gyrations to these degrees that are moving when a president tweets or when a central banker comes out? Individuals are not supposed to move markets. If individuals are moving markets, let me let you in on a little secret. We don't have markets. Markets are supposed to be comprised of millions, if not billions of people coming to the marketplace to make a decision as to what something is worth, what this company's shares are worth. Not a president tweeting, not a central banker coming out and saying, I'm going to continue with the punch bowl. I'm not going to take the punch bowl away. I know you crybabies threw your hissy fit when we said we were going to take it away, but no, you cried. We heard you. We don't want you to be like that. We don't want you to up your Zoloft and your antidepressant medications. We don't want you to hit the bottle even more than what you already do. We don't want you to cry yourselves to sleep. We'll come back, and we'll come back with this fraudulent policy of zero interest rates, of quantitative easing. Don't worry, we're coming back to save you. It's despicable. It's disgusting. But that's what they do. And this is the world over. It's not just the Federal Reserve. It's also the ECB. It's the People's Bank of China. It's the Bank of Japan. It's all over the place. It's all over the place, and there's no end in sight. Oil is at $64.22 a barrel. Gold rallied a little bit. It's at $1,310 an ounce. I think that's touching on a 2 weeks high there. So that's starting to catch up a little bit. Silver sits at $15.17. The 10-year Treasury, again, this might be a flight to safety because we had the yield decline even further. Now it sits at 2.477%. 10-year Treasury is down, now sits at 2.477%. So we're kind of at odds again. We have the 10-year Treasury bond catching a little bit of a bid today. That's typically indicative of a flight to safety, but at the same time, you've had the Russell 2000, the small cap index, rallying 1.4 percentage points today. Again, disjointed. Something's amiss. So you have to ask yourself who's right, because they both can't be right. Is the bond market right, or is the stock market right? Because we didn't get much movement within the S&P or with the Dow. They were relatively flat. NASDAQ was up 55 points. That's not a bad gain for the day. But, I mean, that's tech. That's people flocking into tech, hoping that, tech is the savior of everything, and tech's going to be here for the next whatever. Well, if that was the case, then the dot-com bubble never should have burst. Because technology is always going to be here. There's always going to be some type of new technology. So, again, I just think this is another bubble in the making, if it already isn't in a bubble. It is in a bubble. It is. I mean, that's my argument at the end of the day. The whole stock market's in a bubble. I mean, just graph it out. Look at it. Record highs, which if it was on the back of organic growth and a very strong and robust domestic economy and global economy, then you'd say, okay, well, maybe that's justified. But then when you dig in deeper into the numbers and you look at the U.S. economy and you really look at what the consumer has been going through these last 10 years and what they're going through now, if you look at the rate of delinquencies on auto loans, if you look at the amount of debt on corporate balance sheets, record highs. If you look at the amount of debt and defaults coming up on credit cards, if you look at $1.5 trillion in student loans and what that has, not only economically, but socially and politically, I mean, none of this is good. Nobody can make a good argument for this. I don't care if you're the biggest of bulls for this market. I just don't know how you can spin it. I mean, you would have to be a bull blank artist. I mean, that's exactly what you would have to be, because you can't make heads and tails of some of this stuff. But some of it you can, like the numbers that has to deal with the debt. And people just shrug it off. Well, debt doesn't mean anything. They'll pay it. Well, then why did we have the housing crisis if debt was no problem? I mean, this is the joke. These are the arguments that people want to brush off and say that doesn't matter. It most certainly does. It most certainly does. And you better prepare yourself, because when the day of reckoning comes, and it's coming sooner rather than later, believe you me, you better be prepared. The VIX lost about 7 percentage points today, which now sits at 13.30. So, all right, some things moving in tandem, some things decoupled. Yesterday we had a discussion in regards to Ray Dalio, hedge fund manager and billionaire, founder of Bridgewater Associates, the largest hedge fund in the world with $160 billion in assets under management. He recently posted an article in regards to capitalism, saying that capitalism needs reformed. We said, no, Mr. Dalio, that's incorrect. Capitalism does not need reformed, but rather free market capitalism needs to be reinstated in the United States of America. So just real briefly, a recap on that, because there's more to come on that. But there was some other news that came out in regards to the European Central Bank, the ECB, and the Federal Reserve minutes from their meeting last month. So I want to touch on those things. But real briefly, just in case you didn't catch yesterday's podcast, where we had the discussion in regards to Mr. Dalio's article regarding reforming capitalism, within his own article, and again, I'm not finished with it. It's a lengthy article. There's 2 parts of it. But so far within the first part, Mr. Dalio and his team do a fantastic job of identifying many, many problems that exist within the United States of America. A lot of this, at least so far, he has paid most attention to education and how children and young adults just simply aren't having the right opportunities. They aren't reading, writing, doing basic math at their grade level. They're falling behind. What does that translate into? If these kids fall through the cracks of the system, they're more likely to be incarcerated. They're more likely to have, obviously, lower incomes and almost become more of a burden on society as opposed to a productive member of society, whether that's in the job market or just being an outstanding citizen and potential parent to raise their children to be productive in one form or another. So it becomes a vicious cycle. Again, I applaud Mr. Dalio and his team on identifying this. This has been a problem in this country for a long time. He compares the United States relative to a whole host of other nations. And despite the fact that we are told the United States is the best country in the world, well, when you look at a lot of the metrics that he pulls up there, we ain't even close. We ain't even close. So it's one thing to have a tagline, a political button pin that you put on your shirt during the presidential campaign saying we're the best, we're number one. Well, start looking at the numbers and you'll see ain't true. Sorry to tell you, but on a lot of fronts, and these are important fronts, and again, I applaud Mr. Dalio for bringing this to the forefront. This needs to be a national discussion. However, even within his own arguments and the data in which he presents, he isn't criticizing capitalism. He thinks he's criticizing capitalism, but he isn't. He's mistaken. He is criticizing our government, our failed politicians, our failed policies. That ain't free market capitalism. When the government's managing and standardizing a whole host of things, and everybody knows that education is most definitely run by the government, the vast majority of it, public schools, all over the place, state, local, federal, that ain't the free market. The free market would be private institutions. And even in his own data in which he presents in the article, private schools outperform their public school counterparts. I mean, that's no surprise because you have people within those private institutions that are saying, look, we're entrepreneurial here. We're going to run the show how we deem is the best way to do so. We're going to work in collaboration with the parents, with the students, with other professors, with other entrepreneurs and other private schools, however they want to do it, with other countries, other states that are productive. We're going to follow best practices. And as a result, they get better results. That's common sense. That's a free market capitalistic solution. Turning everything over to mommy and daddy government to say you deal with it is not capitalism, sir. It is not free market capitalism. That's abandonment. And when you have the government running stuff, that's called socialism. That's what it is. That's what it is. You have Social Security. How's that working out? A lot of people aren't going to get it. They're just not going to get it. How about Medicare? These things are bankrupting the country. These are not free market capitalistic solutions. These are governmental solutions, and a lot of this is government run. If it's government run, it isn't free market capitalism. It's socialism, or it's a form of fascism or corporatism, which we talk about here. That's what exists within the United States of America. It's a perversion. It's a hybrid of corporatism and fascism, whichever word you want to use, which basically means it's the merger of the state and major corporations, and then you got a big side and dessert of socialism. And when you got the lunatics running in 2020, crazy Bernie, maybe crazy Uncle Joe Biden, Pocahontas, Spartacus, the list goes on and on and on into the night. It's a new one getting into the race every day. It's going to be more socialism. That's what they want. And because of the socialized education system, we have more lunatics willing to vote for them. That ain't capitalism. That ain't a failure of capitalism. It's a failure of the people not being educated and informed because they just take for granted what they're told from their government-run education system, from their uber-liberal professors in college if they get in, which of course they get in because that's why they're sacked with $1.5 trillion worth of debt. They just, here, education's important. Don't worry about what you're getting an education in. I mean, worry not what you're going to get paid, what the skills that you acquire are actually going to be worth in the marketplace. Just go ahead. Just follow your dreams there, and everything will be okay. Well, wake-up call. Life ain't that easy, and a lot of people are unfortunately being disappointed. I mean, they're hitting a real-life lesson right in the face because they were told you go to college, you do this, you're going to come out, you're going to get a good-paying job. Well, most of these people, unfortunately, aren't coming out of college and walking into a good-paying job. That's a failure of the government. It's not a failure of capitalism. Capitalism wouldn't allow all of these students to get these loans because they would base it off of merit. They would say, look, you want to get a degree in engineering? All right, you must be smart then. Let's look at your grades. Let's look at some letters of recommendation. All right, John, you're going to be an engineer. Seems like you can do it. Good letters of recommendation here. Good little resume from high school. Great grades. Here's what you want to do. You already got acceptance letters from these top-tiered schools. Yeah, you're a good risk. Well, the government doesn't care. Maybe you want to be, and I don't mean to belittle anybody, but when you're going to compare an engineering degree to somebody who goes and gets a communications degree, I mean, there's a big difference. I mean, once you're an engineer, you basically start learning engineering from day one. All right? And then when you're out, when you graduate, you're going to be making good money. You're going to be making really good money. Conversely, if you're somebody who says, well, I want to be a communications major, you're probably not going to start your major until your sophomore year, maybe even your junior year. So you basically have 2 more years of glorified high school general studies that cost you $20,000, $40,000. Makes absolutely no sense. Absolutely no sense. And on top of it, the universities have the audacity to teach you ethics. All right? So the government, when they come in, they say, oh, yeah, everybody, yeah, you want a communications degree? Here's the loan. Sign up for it. No problem. It doesn't matter. We're going to give you the money. You want to be an engineer? Fine. Here's the money. Makes no difference. The free market capitalism would say, whoa, wait a minute. If I'm going to send my money out there as an investment, as a loan, I want to make sure that money comes back to me plus interest. All right? There's nothing wrong with that. But they have to do their due diligence. The government doesn't care. The government because they just want their numbers up. Politicians just want to go out there and say, look, the numbers are up. The numbers are up. That's not how it works. There's no accountability. That's why we have $22 trillion in debt. So that's basically just a quick recap of what we were talking about. And that's really what the heart of this podcast is all about. The Economics Show. Free market capitalism. Something to believe in because it works. Mr. Dalio, unfortunately, is incorrect. His team is incorrect with saying that capitalism needs reformed. Our government needs reformed. It needs to be done. It needs to be abolished in the way in which it operates. We need free market capitalism. We need a limited government, not one that spends $4 trillion a year with no accountability. That ain't free market capitalism. That's socialism. That's fascism. And you better believe it. Now, getting on to some of the news in regards to the ECB, the European Central Bank. The ECB holds interest rates as Draghi, the president of the ECB, warns of downside risks. Are we surprised by this? Interest rates on its marginal lending facility and deposit facility will remain unchanged at 0%, 0.25%, and negative 0.4%. Negative. Still in negative territory in some of these places. Unbelievable. Speaking at a conference in Frankfurt, Germany on Wednesday, ECB President Mario Draghi warned that data gathered by policymakers in recent weeks had confirmed, quote, slower growth momentum in the Eurozone. Well, I don't know why it takes a genius to figure this out. I mean, we have a couple brain cells to rub together on this podcast, and I know you guys do as well. I mean, we didn't see this coming. We saw this coming. Why didn't they see this coming? Because they did a 180 policy reversal too. Everybody was on, okay, we're gonna normalize. 2018 is going great. Everything's fine and dandy. We're going to normalize. Then the crybabies the world over throw their hissy fit. Markets enter correction territory, bear market territory. No, we made a mistake. We can't do that. We can't take away the punch bowl. The babies need their punch. And they give it back to them. And we've seen a V-shaped recovery ever since. And we had the discussion the previous week in regards to the monetary base here in the United States, along with the Wilshire 5000 total stock market index. And we looked at how the effects of quantitative easing have affected the stock market. And this stock market has been bought and paid for by quantitative easing. Now, it's been bought for, I argued, by the Federal Reserve and other central banks, but it's being paid for by you and me because you got higher costs of living. Most of you don't own a whole bunch of stocks or financial assets. Okay, I'm imagining most of my listeners are in the middle class. You might have a 401k. You might have some stocks here and there that you trade or you're involved with, and that's all good. You might have some bonds, might have some precious metals. But it's nothing that's necessarily making you a millionaire or not a millionaire overnight. But when you have people, even like a Mr. Dalio, who makes his living managing $160 billion, I mean, his net worth personally and that of his fund has gone up over this past 10 years because of all of the funny money. That's where the money went. It went into financial assets. And Mr. Dalio, his fund is basically the king of diversification. So they got it all. They got stocks, they got real estate, they got bonds, they got gold. I mean, they have it all. And they've made out like bandits because they understand the game. All right? Now, the fact that he's saying that capitalism needs reformed again is wrong, but that's his argument. And we're going to rebut that argument on this program, and we will continue to do so. Continuing here with the ECB, economic uncertainty relating to geopolitics, protectionism, and emerging markets had negatively impacted investor sentiment in the bloc. He added with risks, quote, tilted towards the downside over the coming months. We know this. We talk about this stuff all the time. We talk about Brexit. We talk about the U.S.-China trade war. We now talk about the U.S.-EU trade war that's taking place. We talk about what's going on in Venezuela. We talk about a whole host of issues. The housing bubbles that exist the world over, a whole host of things. So now what we're likely to see again from the ECB is another round of their quantitative easing set to take place perhaps beginning in September. And it will end in March of 2021. Everything was supposed to be great. They were supposed to do all this quantitative easing here in the United States, around the world. Obviously, here we're talking about the ECB. What's going on then? Why do you need to do another round? Why is the president, our president in the United States, Donald Trump, out there saying the Federal Reserve needs to embark on quantitative easing number 4? And the Federal Reserve needs to also cut interest rates by 50 basis points. I thought everything was fine and fantastic. These are emergency measures. These are panic button measures. So why are we calling for these measures if everything is fine, dandy, and rosy? Makes absolutely no sense. Now, do you get any reporters with the cojones to ask these basic questions? No, of course not. Of course not. In fact, you get a bunch of talking heads on Bloomberg and CNBC and Fox Business saying, well, this is fantastic. The stock markets are just going to rally. Up, up, and up. At whose expense? At whose expense? The middle class. Lower income class people. That ain't right. That ain't free market capitalism. That's fraud. That's counterfeit. That's printing money so it goes into financial assets. Maybe it will, maybe it won't. Again, remember our discussion of the 30 top market risks for 2019. Again, one of my biggest concerns is the fact that these central banks come out, start printing money again, and everybody says, uh-oh, it's out of juice. Then what? Then where do you go? Where's the bottom? Where's the bottom in the stock market? Where's the bottom in the bond market? I mean, where's the bottom to any financial asset? Because this thing has been completely reflated and inflated over the past 10 years. So look out below. I'm telling you, that is a concern. Diminishing marginal returns one day will kick in. Now, on our side here with the Federal Reserve, we have the minutes of last month's meeting released, and the Federal Reserve reaffirms its patient approach on interest rates. Fed officials do not expect to make any changes to interest rate policy this year amid concerns about ongoing trade talks, Brexit negotiations, and an economic slowdown in Europe and China. Minutes of the March meeting showed. Policymakers also noted that their views of the appropriate target range for the federal funds rate could shift in either direction. So I guess there's a little bit of a teaser out there. Maybe they'll go up, maybe they'll go down. We don't know yet, but most likely they're just going to stay put for the remainder of 2019. Maybe there'll be one increase in 2020. But you have to remember, folks, this is a presidential election. The president is dancing. He took ownership of this economy and the stock market foolishly. And he is afraid that if it goes down, either of them, the economy and or the stock market, that he will not win re-election. He's concerned about this. This is why it's a foolish move to take ownership of the stock market, especially if you're the president of the United States. You don't do it. I don't know who's advising him, but they gave him terrible advice. If this was his own instinct, he made a mistake. Can he can he dance himself out of this box? Yeah, he can. He can, because he has the bully pulpit and he has very, very loyal members of his base. And I also think if he attacks the right people, most definitely the Federal Reserve, which he is beginning to do, I think he can get a lot of people, even in the middle, on board with that, and even some Democrats to say, all right, he's finally talking about it. Because there are Democrats, and I even have to give credit to crazy Bernie Sanders, and even Pocahontas, who goes after some of these big banks and the Federal Reserve. Because they've been making out like bandits over the last 10 years, while the average American has most definitely not. So if President Trump attacks the Federal Reserve, I think it will do him well. We here at the Capital News want the Federal Reserve abolished. We want the income tax abolished. If people do not talk about the Federal Reserve and the income tax, and saying you got to get rid of both of them, then I don't take them seriously. Everything else is just kicking the can further down the road. You will be swiping at the branches. I attempt to strike at the root. The Federal Reserve and the income tax are the root of our problems. Okay? So pay attention to those things. We have to pay attention to what central bankers are saying because it moves markets. And we just got to stay on top of it because these are interesting times. We have these market gyrations, again, of 1% to the upside, then 1% to the downside, or vice versa. Got to pay attention to it, folks, I'm telling you. And have a plan. Have a plan. Be prepared. Even if it's taking money off the table and just letting it sit in your account, waiting for that day of reckoning to come, that's fine too, because you're going to have deals of a lifetime on the other side. You will have some of the best companies that are still in existence once this thing goes down to the downside, and you want to buy them up with both fists. When there's blood in the street, buy real estate. Thank you so much for joining me today, ladies and gentlemen. It has been a pleasure having you. As always, please like, share, subscribe, get the word out. Leave your comments. I would love to hear from you. This is the Capital News. I am Alex Koritis. Godspeed.